Housing affordability in the US is now the worst it's been in 40 years. 30-year mortgage rates are approaching 8%, and even when adjusted for inflation, housing prices are now significantly higher than they were in 2008. And all of this has many people wondering if this is going to lead to a crash far worse than that of 2008. And the truth is, almost every market in the US is overpriced, interest rates are at an all-time high, and affordability has gotten significantly worse, especially if you are a low-income earner. But that doesn't mean that just because housing prices are higher than they were in 2008 that the bubble is definitely going to burst. Because today's market brings a whole set of new challenges and significantly different challenges than we faced leading up to the Great Recession. But before we get into it, my name's Noel Matthias, and if you're new here, do me a favor, hit the subscribe button and hit the like button so more people like you can find this video. Because even with all the great videos that are being made on this subject, there's a lot of misinformation out there, and there is a lot of misunderstanding with respect to whether or not this is similar to what happened way back then. And while there are certain similarities for sure, the reality here is you just can't look at prices and go, oh, they're higher than they were before, so clearly that means that things have to collapse. Because that isn't exactly how economics works. But that also doesn't mean that there isn't going to be a correction. And in this video, I am going to discuss all the stats, all the data, and what could potentially happen in the market in both the positive direction and the negative direction, and how you need to change your thinking when it comes to the real estate market. So let's start by jumping in and taking a look at a whole bunch of really relevant but simple to understand data. Let's start first with home price affordability in the US. Now, it's clear that houses are significantly less affordable than they were in 2008, and they're actually significantly less affordable than they were going back to basically the 1980s. And the reason for this is obviously we're having the combination of both higher prices and higher interest rates. And that's made the affordability numbers some of the worst that we've ever seen. Now, that in and of itself indicates that something needs to break, and something will break in the American real estate market. There's no doubt about that. The question is, what is it? And it may not necessarily be housing prices. There are some reasons why housing prices could stay high, and there are also some other factors that could lead to affordability coming down while housing prices remain high, and I'll get into those in a second. But even though we've got this massive run-up in prices, I also want to show you what this price run-up looks like relative to the 2008 price run-up when adjusted for inflation, because we all know inflation is high, but what is the real effect of that on real estate? Well, this is what it looks like. Inflation adjusted, housing prices today are higher than they were in 2008. And the question is why? Why are they so much higher now than they were before? Well, in 2008, it was pretty clear that housing prices were going up because people were basically day trading homes. And this was the big mistake. People were buying homes with the expectation that values could only go up, and if you could find good renters, you could continue to own those homes without any risk. And that just clearly wasn't the case, as we found out. As soon as mortgage rates started to adjust, we saw the economy pretty much unravel, and therefore we saw the housing market unravel with it. And I'm not going to tell you that this time is different, because it's not. Housing prices are clearly higher than they were in 2008. But the fundamentals, the things that could affect the market, have definitely changed. The lending practices of 2008, for the most part, no longer exist. And there's some new factors that have come into play in the last couple of years, specifically household formation, that are going to have a stabilizing effect to these higher values. The question is how much. But before we talk about that a little bit more, let's talk about the differences between 2008 and today. Specifically, the 2008 housing bubble in the US was a speculative bubble built on the back of people trading houses as if they were stocks. And not just trading them like they were stocks, but day trading them. Buying a house with the expectation that 1 month, 3 months, 6 months down the road, it would be worth significantly more than it was on the day it was bought. And for a lot of people, this happened, until of course the housing market busted. Now, in comparison to that, the 2024 housing market bubble, if you can call it that, is based on significantly different issues. This is no longer an investor-fueled day trading bubble, although there is a little bit of speculation that has clearly driven it. But for the most part, the run-up in prices actually comes from a significant change in household formation. A new household formation combined with the fact that there is a bulk of mortgages that are still at super low interest rates and that will be at those interest rates for at least the next 25 years, assuming that people hold on to them. Well, there is some support for the market prices as of today, because there is a significant amount of people who have bought houses over the last 2 years who bought them at yesterday's affordability rates. So in other words, they paid yesterday's prices and they're still paying yesterday's interest rates Oh, and by the way, they're getting to pay those at today's incomes, which in a lot of cases are higher, thanks to inflation. But before I get into that, I think it's worth taking a look at the household formation differences in the last 10 to 15 years to show you how significantly different they've been in the last couple of years. As you can see from this chart published by Harvard, the difference between household formation in 2011 to 2016 versus 2016 to 2021 is drastic. I mean, just look at the 35 to 44-year-old age category, where in the first part of the 2010s, housing formation was actually negative. And between 2016 and 2021, housing formation increased substantially. Add in 2022, 2023, and I can assure you that these numbers are even higher. And when you look at the cumulative data, you can see that household formation is significantly higher during this time than it was at any other time. In fact, 30, 40, 50% higher. And this is what's created the supply issue in real estate markets across North America. There's simply not enough houses available for the amount of new households that are being created. In fact, according to the National Association of Realtors, we are up to 6.5 million homes short of what we actually need. And in order to catch up, housing starts would have to triple, which is a number that is probably not going to happen anytime soon. Because unfortunately, even though housing formation continues to rise, often even when there's a recession, housing starts tend to flow with the economy. And in both the pandemic recession and the recession that is about to hit us in 2024, housing starts are going to continue to decline and not keep up with the pace that are needed. Now, you might be wondering why household formation is so high compared to the past. And the answer to that is actually really quite simple. This is the first time in quite some time that we have had multiple generations competing for households. And even though we should have seen the competition for households from millennials and Generation Z coming, we just simply didn't. And as a result, you have the baby boomer generation, which is largely considered one of the largest generations in history, competing with the millennials for the same housing stock. And in addition to that, you also have Generation Z starting to compete. And the reason why housing prices went up so much during the pandemic is because a significant amount of younger people who would have been purchasing houses well out into the future moved up their buying decision into early 2021 and 2022. With interest rates at historical lows and housing prices starting to get out of reach, a lot of people jumped into the market a lot sooner than they would have typically. And this obviously led to a massive run-up in prices to the tune of 17 to 18% that we hadn't ever seen before. The reason why? More people competing for houses that simply weren't there to buy. And here's the thing. A lot of those buyers ended up being able to buy at very low interest rates and very low real estate prices. And as a result, those buyers, those millennials and those Generation Zers that were able to jump into the market are now living in houses that they bought at yesterday's affordability, which means they're going to be highly unlikely to put those properties out on the market for sale, meaning that the amount of supply available to new buyers is going to continue to be low. But that's unless one thing, and one really important thing, happens, which I'll get to in a second. But what you have to understand here is that the growth in housing prices in the US was borrowed from 3 to 5 years in the future. Eventually, we probably would have seen housing prices get to these levels. However, we saw it happen in a very short period of time because of the pandemic and because of the fact that millennials and Gen Zers realized that, hey, being in a couple, that's cool. Not living with your parents, that's cool. Owning a home and being able to do those things, that's even cooler. So they jumped into the market. And as a result, that price growth that probably would have happened anyways got moved into 2020, 2021, and 2022. So even though charts like this one would seem to indicate that housing prices are far too high and that the bubble should burst, the reality is that a significant amount of homeowners got in at this portion of the bubble, not up here. And if they continue to be able to pay their mortgages at yesterday's rates, they're going to continue to hold on to those homes. And subsequently, there's going to be a support level for the value of houses where they're at today. And more than likely, what will end up happening is you'll see prices remain fairly flat, maybe come down a little bit, and over the next couple of years, intersect with this line somewhere where it would have been if the prices had gone up gradually. Now, all of that is dependent very much on one thing, and that is the unemployment rate. If the unemployment rate remains low, expect that housing prices are going to also remain high. But if we enter a recession, if there's a lot of job losses and the unemployment rate goes up significantly, that could be the point in time where the real estate market fractures and we see it come down. The question is, will it come down as much as it did in 2008? And the answer to that question is nobody knows. So no matter what you see on YouTube with videos that are scary that say the housing market collapse will be way worse than it was in 2008, the reality is nobody has a crystal ball that can see that far in the future. And there's one other thing to point out. In 2008, there was a significant amount of loans that had adjustable rates. And when those adjustable rates started to adjust, that is when the market collapsed. In today's market, the significant majority of mortgages are 30-year fixed mortgages, and that adjustable rate phenomenon that caused the 2008 collapse is a lot less likely to happen. Now, that being said, with affordability being as awful as it is, we have to also realize that at some point that will return to the mean. Housing prices cannot remain unaffordable forever. So the question is, what are the things that could happen to see housing affordability return? Well, the first and obvious one is housing prices fall. That could happen if there's a significant increase in unemployment. It could also happen if significantly more housing supply comes online. And I'll link to the video at the end of this one, but that's why Warren Buffett just made a huge bet on the US real estate market, is because he expects that home builders are going to build more and put more supply in the market as that sector becomes more profitable. Now, the other thing that could return affordability is if interest rates went down. And yes, if there is a recession, this is a real possibility. But also keep in mind, if there's a recession, that will also mean higher unemployment, and it could be a combination of those two things that returns affordability to the US housing market. But the third and the most unexpected option, which could become a reality, is inflation, and wage inflation specifically catches real estate values. So in other words, the real estate market could remain flat, and we could see wages go up, the cost of everything else go up, and that eventually catch the real estate market and return it to more affordable levels without housing prices coming down. And in the most likely scenario, it's a combination of all of these things that happens. We see housing prices come down a little bit, interest rates come down a little bit, and we see some wage growth that basically creates a scenario where everything comes together and things get a little bit more normal again. Now, that being said, a catastrophic collapse in the economy and the real estate market could happen if any one of those things has a major change. And a major shift in any of those items is not unreasonable to expect. We just won't know, like in 2008, what causes the shift until it actually happens. But a soft landing that sees a gradual rebalancing would definitely be ideal. And understand that there is going to be a rebalancing in some way, shape, or form. It's just a matter of which economic indicators and which economic factors do the rebalancing in the market. But it may not be the value of homes. Now, that being said, it could also very well be the revaluing of homes. So obviously there's a lot of uncertainty on what could happen, and nobody knows what is going to happen. So the question is, if I'm a buyer, a seller, or a homeowner, what do I need to do in order to make sure I make the right decisions? And this is the single most important thing that you need to understand. We need to shift our mindsets around real estate from being a short-term transaction, 3 months, 6 months to a year, and start focusing on real estate as a long-term transaction. We need to recalibrate our thinking towards these being 10-year purchases, not 1-year purchases. Because the major thing that has changed over the last 25 years in real estate in the US and in North America is that people have stopped thinking about it as a place that you buy in order to live in for the rest of your life, and instead have started thinking of real estate as an investment that will make you money and make you rich. And if we as a society can return to the idea that a home is a home and you're meant to live there for a long time, and make those buying decisions based on the fact that you're going to live there for a long time, well, that will make the decision-making process significantly easier. Because if you look at even in today's market, if you were to buy a home right now, expecting that the market's probably going to be flat over the next 2 or 3 years, and then waited for interest rates to come down, if they do in fact come down, and refinance to a lower interest rate, well, at least you've been able to purchase a home that you know you can afford for a 10 to 15 year period. You're not paying a bunch of money to a landlord and losing it every single month, and you're creating some stability for yourself and for your family. And at the end of the day, that's what owning a home is really about. It's about a long-term time horizon and creating stability for your family. So even though it might seem expensive, the right time for you to buy real estate is always the time that's right for you. Because if something else happens that spurs the real estate market up another 10, 15, 20%, sitting and waiting for the market to come down and trying to time it is just going to prove to be a fool's errand. And yes, you may wait 1 or 2 years and you may see housing prices go down and you may time it just right. But if housing prices stay flat, well, you just created a scenario where it's going to take you 2 or 3 years longer, 25 years down the road in order to have that home paid off. So think about your buying decisions with the long term in mind. And if you want to check out that video on Warren Buffett making a huge bet on the US real estate market, check it out right here.